The budget is made up of two main components, income and expenditure. In India, the expenditure is usually higher than the revenue. The difference between the government's expenditure and its revenue is called the fiscal deficit. In simple terms, it is the money that the government spends in excess of its income. This deficit is calculated as a percentage of India's GDP. The deficit rises when the government's expenditure rises or the income falls. On the other hand, it shrinks when the income rises or the expenditure falls. The income and expenditure of the government are of two types, capital and revenue. Capital transactions are long-term and lead to a change in the assets and liabilities of the government, like buying new land or vehicles. Revenue transactions, on the other hand, are recurring in nature, like pensions and salaries. When the government spends money on acquiring long-term assets that will generate revenues for years, it is called capital expenditure. This includes money spent on building roads, bridges, and factories, among other things. While we have talked about capital transactions, there are some transactions that do not lead to a change in the assets and are temporary in nature. These are called revenue transactions. Some incomes like taxes and rent from property are called revenue receipts. On the other hand, expenses like interest payments, salaries and pensions are called revenue expenditures. The budget that lists these revenue receipts and the expenditure met using those receipts is called the revenue budget. It simply tells us where the government is getting money to meet short-term expenses. The budget also allocates money separately for subsidies. A subsidy is a benefit given to an individual, business, institution, or particular sector. These are given to reduce the monetary burden and in the interest of the public. Subsidies can be direct in the form of cash payments or indirect in the form of tax breaks. The subsidies aim to reduce the price of a particular product in the market, or as in the case of the fertilizer subsidy, to compensate producers for selling their products at a price lower than market prices. Even the production-linked incentive scheme is a form of subsidy. Sometimes, the money kept aside by the government in the budget may be different from the amount it spends on a sector in the year. The numbers it announces in the budget are called budget estimates. Budget estimates represent the government's wishes and ambitions. Revised estimates show how the expenditure is likely to pan out. The two estimates may vary, but not hugely.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.